Good afternoon, or I guess possibly good morning to some of you as well, and thank you for logging in today to our webinar on getting started in multifamily real estate investing. It's another one of our educational classes that we're holding today to try to bring in a new topic or a little bit of a different topic than something we ordinarily talk about. And we have a great guest speaker who's going to be joining us in a few minutes and getting her information and having her teach a little bit today on multifamily real estate investing. My name is Scott Maurer. I'm the Director of Business Development for Advanta IRA. I'm the moderator and then somewhat host a little bit of today's webinar. I've been with the company for a number of years now. I've done a lot of different jobs throughout the company and helping people through transactions, whether they're buying a single-family rental home or whether they're looking to invest in a private placement or a syndication deal that's with real estate involved. So I've been with the company for a number of years, spend more of my time now really focusing on the business development side. And I'm really happy to bring the webinar content to you today. I think it's going to be very good information for some of you who are either not familiar much with multifamily investing at all, or as somebody who maybe has a little bit of experience. But it's a topic and a subject we've been getting a lot more interest in lately. So we thought it would be a good idea to bring that topic to life and get someone to speak intelligently on that particular subject. Now, today's webinar is being recorded, so if you're listening live, you'll be able to go back and listen to the playback version on our YouTube page. If you are listening to the recording, both my contact information and that of our guest host and guest presenter will be available as well for you to go back and listen on the playback. So if anyone who's listening live today, if you have questions as we go through the webinar, whether it's on what I talk about with the self-directed IRAs or whether it's something our guest talks about, please type those questions into the chat box on your screen. We'll make sure we get those answered at some point during the presentation. Now, a quick disclaimer, something we always put forth at any live seminar or webinar that we do. Again, Advanta IRA does not provide legal, tax, or investment advice. We don't endorse any products, and we're also not affiliated with any company, even including people we might have on as a guest presenter. We exist to hold self-directed IRA accounts and do the record keeping and administration associated with that. But if you need legal assistance or tax advice or investment advice, we can certainly encourage you to consult with your own attorneys, your own accountants, or we can refer people to you as well who are knowledgeable on self-directed IRAs and the particular issues that you have. Now, just a little bit of background on Advanta IRA if you're unfamiliar with us. We've been in the industry for many years. We have over actually $1 billion in assets now. The slide is a little bit old. We have over $1 billion in assets. And the one thing that we really focus on here at Advanta is a personal touch. We give great customer service. We assign all new account holders to one individual in our office who will help them regarding any aspect related to their account, whether it's making their investment or just general questions that they have as they are self-directing their IRA account. The other way we like to set ourselves apart, and you're part of that today, is our Learning Center, what we offer as far as educational topics and educational events for both our clients and non-clients alike. We do a lot of live seminars in our Tampa and Atlanta offices. We do a lot of the online trading such as this one and try to put other networking events as well for people to meet and share a lot of good information. We have an on-demand channel on our YouTube page. If you go to our website, we got a direct link to that. You can watch all of our past webinars that we've recorded are available for you to download and to watch at your convenience as well. So we try to really, again, focus a lot at Advanta on customer service and also on the aspect of education and really getting people the information they need to properly control their accounts. Now, for anyone on the webinar who hasn't heard of self-directed IRA before, so I'm not sure how many people we might have that fall into that bucket, but the reason why a lot of people haven't heard of self-directed IRAs is simply that most individuals who have a retirement account, they have an IRA or they have an old 401k, that account is sitting with a bank or a brokerage firm, a company that is offering them only those products that they sell. The IRS regulations allow for a very, very broad range of different investment, but each custodian can decide what assets that they're willing to hold. And again, banks and brokerage firms are not interested in holding real estate, whether it's, again, a single-family home or, as we're going to talk about today, multifamily syndication interest. It just doesn't fit their business model, so they don't want to hold those assets. So that's why people seek out our services, and then a self-directed IRA is one in which you are in control of the actual investments, what you choose, what you want to invest in, regardless of what your custodian necessarily is going to allow you to do. And that's, again, a reason why a lot of people choose to work with us at Advanta, is they're looking for, they've identified an investment opportunity that simply their current IRA custodian is not willing to hold. The IRS will allow the transaction, but their current custodian won't hold it. So that's why a lot of people haven't heard of self-directed IRAs, because your bank or brokerage firm typically is not going to make you aware of or offer you different investments that they are not willing to hold. And so ultimately, why do people choose to self-direct? I think that people fall usually into one or more of the following buckets. For some individuals, the IRA is simply a new source of capital. They have an investment opportunity in front of them that looks like a good idea, or maybe they've missed out on something similar in the past. And their IRA, that cash in those accounts, provides them with that capital that they need in order to make that investment. So if I want to invest in a particular multifamily syndication deal, I like the way the numbers look on it, the returns look great, but I need that $50,000, $100,000 for the investment. My IRA might be the place that I have that cash for. So for some investors, it's simply that different place that they can pull money from to not miss out on an investment opportunity. Another reason people choose to self-direct really relates a lot to the stock market, the fatigue of the ups and downs of the stock market, not sure exactly where the next peak or valley is going to come. Instead of investing my money into the roller coaster that can be the stock market, I can put my money into a hard asset like real estate or some other investment that I'm maybe a little bit more sure of. There's a little bit more fundamentals that are in line. Then I'd feel more comfortable. So some people, they're just looking to get out of the stock market. What else can I do? What else can I put my money into? Because again, their brokerage firm is not letting them know what the options are. And for some, there's some tax benefits. Is the impetus for choosing the self-direct. When you invest through your IRA account, regardless of the type of IRA you have, and we'll go over that in just a moment, the different types, the income, the profits that you generate from that investment come back tax-free or tax-deferred back into your IRA. So if I'm looking at making an investment that has a great return that would be coming back to me, if I'm already in a high tax bracket personally, that might be a good opportunity to make the investment inside your IRA account so that all the profits, all the income that you're generating from that investment come back to your IRA rather than to you as an individual as well. So, and kind of in Advanta IRA, we work with a lot of individuals, obviously, who are looking to self-direct on their own. They have their own IRA account. I want to put my capital to use. I want to go find a property. I want to make an investment in a syndication. But we also work with a number of people as well who are looking to raise capital at times. So if you're somebody out there who's looking at your next project, again, whether it's you're looking for money to buy your next rental house or you're looking to syndicate a deal, self-directed IRAs can be a very good source for you as well for you to raise capital. So not only can you put your own IRA account to use in making an investment, other people's IRAs can be a source for you when you need additional capital as well. A lot of times self-directed IRAs are a good capital source because you have a repeat investor, somebody who's already investing with you, maybe somebody who's already lent you money personally, showing them how to use their IRA instead could potentially unlock more money from somebody who already has bought into you as an investor and an investment for them. They're comfortable with that. You're just showing them another way to use more money that they have. A lot of people aren't expecting to use their IRA funds as well anytime soon. So if I have an investment that I want to make in my IRA that might be locked up for 5 or 10 years, I may not want to make that investment with my personal savings account or my rainy day fund, because if it's not liquid and I don't have the ability just to grab that cash when needed, that's not necessarily good for a savings account or a rainy day fund. But most people, they're funding funds in their IRA or in their old 401k, they're not planning on touching that money anyway for the next 10, 15, 20 years. So right now, they're just looking for gains inside the account, and the IRA can be a good source to not miss out on that opportunity. And again, also offering better returns. People who are scared of the stock market may have pulled their money out of an IRA, pulled their money out of the mutual funds or the stocks that they were holding, and right now they're just simply sitting in a money market or a CD, getting 1 or 2%. And if you're someone who's raising capital and offering that higher rate of return, obviously that could be an attractive proposition for someone who has their IRA just sitting in at 1 or 2%. And I think the other reason why self-directed IRAs are a great capital source, at least one of the 4 reasons I have listed here, there's no outside approval needed. If you're talking to an investor It is simply up to them to decide, I want to use my money, I like the deal, I've looked over your financials, and I want to make that investment. You're not going to a bank and going to an underwriter who's going to have to look at the totality of the deal and decide whether or not they're going to lend you money. If you're borrowing from someone's self-directed IRA, it's simply a one-on-one approval process with that particular individual. And again, the funds that can be used for self-directed IRAs, any type of IRA account, if it's an individual, traditional, or Roth IRA account, really the two more common types of IRAs that we see, those can certainly be self-directed. If you're a small business owner, maybe you're self-employed and you have a simple or a SEP IRA, those accounts also can be self-directed. So if you have an account with a designation of an IRA after it, the answer is you can self-direct it. You just have to do the paperwork and the process to move those funds. We also offer an individual K plan or an individual 401k. Sometimes people call those QRP plans or qualified retirement plans. If you own your own business, you could start an individual solo 401k plan. Just has simply larger contribution limits than the IRAs do. The big one that gets missed at times when people hear self-directed IRA, some people do think I have an IRA. It only works for people with IRAs. I have an old 401k through my previous employer. Maybe that won't qualify. And the answer is that actually it does. Any former employer's plan, like an old 401k, a 403b plan, a 457, TSP plans, as long as you're no longer employed with that company, you can roll that money from those accounts into a traditional IRA account with no tax consequence whatsoever. So keep in mind that those 401ks, old 403b plans, not an issue at all for you to use those plans. And certainly defined benefit plans are kind of in that same vein as well. The only restriction on self-directing involves your current 401k, your current 403bs. Those plans can place restrictions on ability for people to use those accounts. Getting money moved, if you want to self-direct, it's either doing a transfer or a rollover. It just depends on where the money is coming from. Transfers are from IRA to IRA. A direct rollover is from that old 401k or 403b plan into an IRA. Those can be done in partial amounts. If you wish, you do not have to move all of your money to a self-directed IRA, so you have that flexibility. And it's also non-taxable. Okay, moving money from one IRA account to another or moving it from an old 401k to an IRA, no tax consequence whatsoever to you to move that money. And you can move money back and forth if you wish. Now, the types of investments, the real estate assets that we see in a self-directed IRA, you have single-family homes, whether those are long-term rentals, 12-month tenants, short-term rentals. We've seen some people even doing some Airbnb properties within their IRA account. Or if you're rehabbing a project, you're not looking for long-term, but merely a short-term flip, that can certainly be done in an IRA. We see private notes and mortgages, mobile home parks, people doing the checkbook control LLCs, which is a whole other topic. I would invite you to check out one of our webinars on that. Tax lien investing, REITs. But really what we're going to talk primarily about today with our guest is really the syndications and the private placements. And that you see people doing that with commercial properties and also multifamily investments. And just to quickly illustrate what that process looks like for somebody who has money in an IRA account, we'll use Jane Smith in this example, has over $100,000 sitting in her Vanguard IRA account. She meets Randy. Randy is looking to raise capital. He's going to purchase and then remodel an apartment complex to get that rented out. Jane wants to invest. She knows Randy has done this before, has a good track record. Randy is going to give Jane the prospectus and the subscription documents essentially to join his private placement. That's something for Jane, again, to do her due diligence on. That's not something that Advanta is going to do on Jane's behalf. Jane will work with us at Advanta to get her account opened. Again, do a tax-free transfer of that cash out of her Vanguard account over to Advanta. And then from there, we will make sure that those funds come from Vanguard as quickly as possible and notify Jane when the funds arrive. And Jane, again, will be appointed to one account manager at our firm who will then work with her to make sure that the documents, those subscription documents for Randy's investment, show her IRA account as a subscriber and that the tax ID number used is our trust tax ID number and not her social. So we will be with Jane every step of the way, making sure these documents get completed correctly, make sure she approves of them as well. Ultimately, we will send the wire and sign the subscription documents on behalf of her IRA. Any future dividends, profits, whatever, are going to come back to Jane's IRA account, not to Jane personally. So again, these proceeds coming back to her IRA have zero tax consequence to Jane to make that investment. So why do people use Advanta IRA? We don't have a lengthy approval process for the investment paperwork. Again, our role is to make sure it gets titled correctly. We work with people with private placements for years, very familiar with that type of an investment. You get a private account manager. We try to streamline the process as much as possible, especially if you're raising capital and you're going to have several different investors. We will do what we can to make that process as easy on you as well as your investors as well. And we have flat administrative fees, and we utilize DocuSign in a lot of times with completing investment paperwork and getting the account opened as well. So that kind of concludes my self-directed IRA portion of the presentation. If you want more information on that, you can certainly contact me separately. But at this time, I'm going to invite our guest host to take control of the presentation here so we can see her screen and her slides. Our guest presenter today is Alina Trigub with Samo Financial as a multifamily operator. So we're going to invite her to come on the presentation and talk to you more about multifamily. Alina, how are you doing?
Hi, Scott. Thank you so much. Doing great. Great presentation. Great intro. Thank you again.
Yeah, if you can, go ahead and share your screen, and I'll let you take over. I'll make sure it comes up, and I'll let you know that everything looks good.
Can you see it now?
Yes, I can. So, and before Alina gets started, again, I'll let her introduce herself and give you some more background. But again, as you have questions for either myself on what you just heard or with what Alina talks about, make sure you type your questions into the chat box, and we definitely will have some time during the rest of the presentation at the end to get those questions answered. So, Alina, I'll turn it over to you.
Thank you, Scott, again. Hello, everyone. I hope everyone is doing great today. My name is Alina Trigub, and I'm the managing partner of Samo Financial. The agenda for today's presentation includes a brief synopsis about the entity I represent, the rule of thumb gauge for great investment and strategy. I'm going to cover and talk a few words on the basics of syndications and why multifamily real estate investments are beneficial. I'll give you a short reminder why all of us need to have some sort of passive streams of income in our portfolio. And that will follow by a brief list of ways how we can mitigate our investment risks. Oops. Sorry, I need to go back one slide. Sorry about that. Now, allow me to brag a little about our company. Samo Financial is a part of a large network of like-minded investment companies, which allows us to pool the resources and invest together in prospectively valuable assets. There is a lot of work that goes into our expertise, but when you boil it down, basically we help investors to pool their funds together in order to purchase a property that's more expensive than any of us can afford on our own. More importantly, our job is to make sure that syndication deal provides a good return to our investors, and the next slide will unpack how we do our job in general. We evaluate and research the markets we invest prior to even locating properties there. We perform due diligence on each and every property before making an offer. We don't hard sell. Instead, what we do is we use an advanced questionnaire when we meet our new investors to determine whether there is a fit. We continue to work with each of them individually to understand their needs and to communicate what we can offer to them if they decide to partner up with us on any opportunities. Our investment philosophy is also about improving and beautifying the properties, and we will offer our investor partners to make a positive impact on the communities together with us. Allow me to spend a few minutes on our criteria for investing in a particular location. I'm going to use Dallas-Fort Worth as an example. While Dallas is still considered a relatively inexpensive market, it is fast growing and has been increasingly valuable for many, many reasons. Look at the spectrum of available job providers in the area. They have such large companies as Advanced PCS, Dean Foods, ExxonMobil, Kimberly-Clark, Newman Marcus, Southwest Airlines, and Texas Instruments, just to name a few. It also boasts some of the best large universities, such as University of Texas in Arlington with over 10,500 graduates, University of North Texas with over 8,600 graduates, Tarrant County College District with over 78 college graduates. Excuse me. The job market is consistently one of the strongest in the area, and the job growth rate in that area is also very, very large. The Dallas-Fort Worth metro population is over 7 million, and the metropolitan area of Dallas-Fort Worth includes 146,000 residential jump in 2017 alone. Dallas-Fort Worth also offers one of the most developed highway and public transportation systems, as well as international airport. Bottom line, Dallas-Fort Worth is a large metro area and allows to offer a lot of different things and allows to offer appealing lifestyle for people in that area. Next, let's spend a moment on a simple description of what makes it so enticing to invest in a commercial real estate. Let's use as an example self-storage, which is another commercial real estate asset class. The basic income is acquired from each tenant when they pay for a rented storage unit. On the top of the basic income, there is also an art to also use so-called value-add strategy by offering tenants additional resources and services. For example, if a tenant needs a moving truck to move those things into a storage unit, we would offer that as well. I will expand on the value-add strategies on the next slide. Our expenses are nothing out of the ordinary. They include such common things as maintenance, mortgage, insurance, and electric bill. And whatever is left is the net operating income, or NOI in short. So what it comes down to, investors also benefit from the sale of the asset because the equity as well as the profits from the sale are distributed back to our investors. As I mentioned in the previous slide, the art of the deal is to maximize profit, and the point of using value-add strategy in general. It is done by either increasing income or decreasing expenses or doing both at the same time. So it comes down to basically invoking various ways to use the existing assets to make more money for our investors. Some of these strategies will seem very simplistic, but you will be amazed as to how much more income can be generated. Right off the bat, you will notice that the previous landlord's mistakes are our gains. First, property management must take both workers' and tenants' needs into account. Basically, folks should want to work and rent in a development. As investors, we want to improve our tenants' living conditions so that we can charge them higher rent for the better living conditions. Other value-add strategies is to simply adjust rents to reflect the nearby rates in the area or to deflect expenses, such as having tenants pay for their water usage, or to charge for covered parking in the hard to climate geographic areas, for example.
Hey, Alina, I have a quick question for you, kind of on that. What do you think when the properties you've gone after, or maybe you've gotten under? What do you think is probably the number one or two value-add strategies that you think? I mean, kind of where you've maybe I guess the biggest problem you think that properties have when you take them over.
Absolutely, Scott. I would say the most simplistic strategy is under market rents. what we see in quite a few market areas is when we take it over, the rents that are charged are at least 10% or more on the market. And sometimes even with doing minor tweaking to the apartment, we can charge much higher rents, and it allows us to come in and most often relatively quickly monetize on that strategy. Does that answer your question?
Yeah, it did. I was going to say, is that primarily because maybe the prior owner of the property just had owned it for a number of years and really just never caught up or didn't pay much attention to what the other market? Okay. Exactly.
In a lot of cases, it's mom and pop shops, and people have been owners of the properties for many years, and they don't want to bother with either changing tenants or improving the living conditions, and that's why they don't even bother to make the rents higher in general.
Okay, great. Yeah, and I would just again encourage anyone, if you have questions as we go along, please type them into the chat box on the screen. We'll make sure we get them to Alina. So Alina, go ahead, continue.
Yep. Absolutely, and thank you for that, Scott. Guys, I also encourage you to ask questions throughout the presentation. Feel free to pose them, and Scott will be sure to announce the questions, and I'll be sure to answer any questions you have. Thank you for that, Scott. So when someone wants to buy a large commercial property, it requires a lot of money, even for a down payment. One of the ways to solve the issue of covering this large down payment is to have a group of investors pool money together in order to purchase a large commercial real estate. This pool of people group together into syndication, which buy investments through a partnership. The best example that I could think of to compare it would be an airplane, where the pilots would be the general partners in such partnership, and the passengers would be the limited partners in such partnership. So just like in a partnership, GPs do all the work, the pilots will be doing the navigation and the flying, and the LPs will invest in a seat and let the general partners make all of the decisions. The main roles within syndications are presented on this page. So let me quickly touch upon some of them. I'm not going to go through all of them, but just touch upon the first few to give you an idea. Equity investors, which are also called limited partners or passive investors, it's you, me, our friends, family, and everyone we know. It's people around us that invest in syndication. Asset managers, in a lot of cases, these are the people that are also general partners or maybe one of the general partners. These are the people that oversee the asset overall, make sure it's performing. They're constantly in communication with the property management company. They oversee the strategy of the investment, and they make all of the decisions for the asset overall. SEC attorney. So let me give you a little preamble before I describe the SEC attorneys. These properties, in order to buy these properties through syndications, we have to run it by SEC. The syndications are regulated by Security and Exchange Commission, which is in short SEC. As such, these are extremely specific guidelines as to who can invest in a syndication. Hence, in some cases, in order to be eligible to participate in such investments, an investor must be accredited. A definition of accredited investor entails that it is someone who either makes $200,000 a year for the last 2 years if they're single, or $300,000 a year for the last 2 years if they're married. Or the alternative to qualify to be an accredited investor is to have a net worth over $1 million excluding your primary residence. In other words, depending on the ruling that's utilized for a particular investment in syndication, the investors must either be accredited, or the alternative is some rulings allow sophisticated investors to invest. The definition of sophisticated investors does not have any financial prerequisites. Rather, these are the people that must have a basic financial and investing knowledge and understand the investments that they're going in. So with this preamble, I'm going to cover the SEC attorney. Because these syndications are regulated by SEC, Each syndication must hire an SEC or securities attorney to create all of the legal paperwork from syndication standpoint. And the main document in such paperwork is a PPM in short, or a private placement memorandum. This document includes all of the information about the syndication. It also includes the executive summary or investment summary or offering memorandum, as those documents are sometimes called, as well as the operating and subscription agreements that detail each of the partners' responsibility. They detail how the strategy of the investment is going to go overall, what are the proposed returns for the investors, and why this particular investment is decided upon by the general partners. There are other team members within syndications, and again, I'm not going to go into details of them, but you're welcome to ask questions if you have any during the presentation or afterwards, and I'll share my contact information at the end of the presentation for you to ask questions. Let me list some of the benefits of investing in the multifamily real estate. It is an additional stream of income. It also allows you to diversify your portfolio, as I'm sure a lot of you, including myself, start your investment strategy overall with Wall Street. We all invest in stocks, bonds, and mutual funds. So by investing in real estate, you are diversifying into something outside of the stock market. You also receive a truly passive income. There is no work for passive investors in syndications overall. All it entails to is reviewing the documentation provided to you and deciding on a particular investment. Once you put your funds into this investment, your work is done. Then you just watch it grow and review the updates and start receiving dividends. And then you also build a family wealth for yourself, for your family, and for generations to come by investing in syndications. In addition, you receive periodic dividends. Majority of companies pay dividends quarterly. Some of the companies pay monthly dividends. Without any headache, these dividends are delivered to you either directly to your account or through the checks in the mail. You also help beautifying the communities. When we take on a specific property, we try to improve the units inside as well as the outside, and sometimes certain areas demand for such things as, for instance, building a park for dogs, where there are a lot of owners that have pets, and we want to welcome them to the community. So we would build a dog park, put a bench in that park, and allow owners to have a time with their pets outside and to socialize with each other. In addition, you're basically on the winning side of the generational shift. Just to elaborate, when I say multifamily, I really apply all of commercial real estate assets as well. And again, this table is another way to show you the benefits of investing in a commercial real estate versus Wall Street. As you can see, real estate offers you to have forced appreciation. You build your equity. The leverage is used by using the financing for real estate assets, and then you're also buying into actual physical assets. In addition to having tax advantages, as a partial property owner who invests in syndications, you receive the tax forms at the end of the year that clearly dictate that you're a partial property owner and you're entitled for the tax benefits as being a partial property owner, again, without any type of work on your side, by being truly passive investor. And once more, just to bring home the fact that real estate syndications allow investors to benefit from the most, here is a comparison with REITs, or real estate investment trusts. When you buy into REIT, you own shares of fund. When you buy into syndication, you're a partial property owner. Syndication fees in general are lower than that of REITs. Dividends paid in REITs are treated as ordinary income, which is taxed at your W-2 tax rate. When a property is purchased, the depreciation taken against the property helps to lower the actual income received via the dividends in the first few years. Therefore, the taxable income will most likely be lower than the actual distributions you receive from a syndication. Commercial real estate investments are much less volatile than the stock market. The investors don't have any control as to what goes into the REIT. When investing in a syndication, the investors know exactly what property they're investing in. There is also very limited transparency as to what's going on in the REIT. When it comes to syndications, the investors receive periodic updates that detail what's going on with the property. From our point of view, now is the best time to invest in a commercial real estate, and let me unpack that for you. There are about 76 million baby boomers in the United States, and there are about 77 million of millennials. In 2018, the ages of baby boomers were between 54 and 72. Millennials will have the most spending power out of all generations in 2018 as well as 2019. Baby boomers want to downgrade, avoid any maintenance and headaches of home ownership. Therefore, they're looking for rentals. And millennials enjoy traveling and following the workspace, and that's why they don't mind renting. They actually prefer renting versus home ownership. Baby boomers are 401k generation, and they are in their retirement age or facing challenging in the next 15 years as they plan to retire. Millennials' net worth right now is less than half of what their parents were making at that age. So as good as it has been for us for quite some time, you may want to think about diversifying into more conservative commercial real estate assets. Even if you're on the fence while listening to me, you may want to pay attention to this guy when you think about when is a good time to invest. So as with any investments, there are inherent risks. However, in the commercial real estate, they're much easier to mitigate. As you can see, multifamily investors are protected from risk. The property is always bought through an LLC, which provides a corporate protection. Also, passive investors join partnership as limited partners, which entails that they do not make any personal guarantees and have very limited, if any, liabilities at all. The loans are, for the most part, non-recourse. And again, the loans are guaranteed by the key principals, which are also general partners in a deal, and limited partners are not responsible for this. As you can see, investors' risk is as negligible as it gets. Equity investors are not responsible for anything in a partnership joined by syndication. One more small fact about the risks. It allows us to protect our family future by creating additional, completely passive stream of income. And as I mentioned at the beginning of the presentation, it's very important for us to have multiple streams of income. In fact, I argue the opposite, that without diversification into commercial real estate, we risk diminishing our savings that we set up for our nest egg. That's why it's very, very important to have multiple streams of income, and I strongly encourage everyone to look into diversifying out of one stream into different things, not just real estate, but look for other passive streams of income overall. This concludes our presentation for today. Let me know what questions you have right now, or you're welcome to reach out to me afterwards. My contact information is displayed in front of you. Again, I want to thank Scott for offering to jointly provide this overview of syndications and self-directed IRA to all of you guys, and I welcome any questions you guys may have.
Yeah, great, Alina. Thanks, and great job. And again, I think we have a couple of questions here that came in, and for those of you who are listening here live, please get some more typed in. We got some time to get to them. The first question we had, someone said, is it possible to invest in a partnership that is not an official syndication so that there's no need to file with the SEC? So I don't know how much you want to get into that, Alina, on the thoughts on that. It might be a better question for some attorneys, but I know, I mean, I certainly have seen people invest in a smaller partnership when it may be 2 or 3 individuals just putting their cash together. But I know that there's definitely some rules you need to follow if you're going to be trying to solicit capital. So I don't know, Alina, if you want to touch on that again. Is it possible to invest in a partnership that's not officially syndicated, and how that goes?
Absolutely. And Scott, as you mentioned, I'm not an attorney as well. However, yes, it is possible to invest in a partnership. But what differentiates syndication from a regular partnership is syndication allows passive investors to join in. When you have a partnership, all of the partners must be active. In other words, even if investors don't want to do a lot of work, you must assign them some sort of small tasks that they would do in order to make them active investors, and that will allow you to have an active partnership. Again, consult and confirm this with your attorney. That's important.
And then you mentioned, Alina, you had that slide where you had a number of key components of a good team. So someone asked, kind of talking about a property manager, what are some tips for evaluating a property manager in one of your projects?
Absolutely. So what we do is we have an extensive questionnaire when we look for the property manager. We ask them about their experience. We ask them what kind of background checks they do. We ask them what kind of properties that they handle, because there are no 2 property management companies alike. Some may specialize in single-family homes or in a smaller residential 2 to 4 units multifamily. So we always ask what kind of properties they handle, how much experience they have with those properties, what kind of areas they go to. Because if it comes to, again, I'll use Dallas-Fort Worth, is a large city, so it has a lot of different pocket areas. So for us, it's very, very important that property management companies have experience dealing with the properties in a specific assets. And I'm not going to go into definition of the neighborhoods, but we just want to make sure that these property management companies have experience dealing with the neighborhoods where we go, so they know how to approach it. We also look at the feedback that the tenants provide to property management companies to see whether our values align with the property management companies. We provide them constant feedback, and we stay constantly in touch. We ask them to provide reports to us on a regular basis as to how the property is doing, how it's performing. We make it a joint effort to cooperate on the ways to improve the community and how we can make it a better place for people to live. And we also encourage them to pay referral fees to the tenants to bring additional tenants in. If we see that as an ongoing trend, that tells us that this is the property management that we want to retain, and the tenants enjoy living in the property, and they bring in their friends and family in. So that's the kind of environment and the kind of place we want to create for our tenants. I hope that answers your question.
Yeah, that was good. And Alina, again, one of the things a lot of the people we have on the webinar today might be as well people who are already investing in the single-family space. So they're familiar with buying the house down the street in an IRA or not. Kind of what is it? I mean, is that how you started as well? Like what made you take the jump from single family to multifamily, and did you find that process difficult? Or maybe what are some tips you could share with somebody who's looking at going from that single family home rental property to their first multifamily project?
Sure, absolutely. So in my case, I live in an expensive New Jersey border of New York City area where the property is extremely expensive, and it was difficult for me to find a multifamily that I could personally afford. So I've done an extensive research online and in person, looking for ways to invest and looking for properties to invest in. That's how I came across syndication, started researching it, And I actually joined syndications as an equity partner or passive investor myself initially. And after doing it several times, I really enjoyed the process and I really enjoyed the overall strategy. And I learned a lot by being a passive investor, by asking general partners questions, by looking what they were doing, by observing their strategy and reading a ton of PPMs, believe me. And those PPMs are pretty long and can give you a lot of lessons to learn. And after doing that, I took a course myself on syndications and learned how to do it, and jumped into the game as an active general partner and just started doing it on my own. So go ahead.
Yeah, no, I was going to say that's great. I mean, and I guess one of the things that, and I think maybe went along to that, some people, it's if they're looking, depending on what neighborhood they're in, if they're looking to buy a single-family home, maybe they don't have the cash or they don't want to commit to that large of an investment. Sometimes investing into a passive deal in somebody's syndication or partnering up with other people where you can use 25, 50K, 100K, whatever, where you don't have to get involved in the whole property. Is certainly a potential strategy. Obviously, it sounds to me that's how you did it. One of the questions we had, actually, a couple of people just curious to kind of what the minimum investment is typically in a syndication. I don't know. Obviously, you have some personal experience, maybe what your minimum is, but if if what the general ballpark as well is for people who are doing syndications, what you need as far as capital to be a limited partner.
Sure. So I would say in the ballpark, majority of syndications start at 50,000, 50, although I have seen some that start at as low as 25,000 or go to as high as 100,000. So anything is possible, but the other important factor to keep in mind is to get educated, and we can certainly help you with getting educated, or you can find a lot of information online through the books, and I can recommend a number of books on getting educated in general on syndications or investing in multifamily real estate. Because as I mentioned earlier, syndications are regulated by SEC, and what I mean by that, a lot of them allow accredited investors in, of course, but some of them also allow sophisticated investors in. And to be a sophisticated investor, one must understand what they do, and they must understand the financial terms, the investment terms, and be able to read the offering memorandums in general. So education is the key, and it's very, very important to get your knowledge up to speed prior to investing in syndications or in anything in general in the first place.
Very good. We had another question come in talking about the managing partner, their compensation. And again, not asking you to disclose necessarily what you charge particularly, but kind of what are typical managing partner fees? Is it typically a percentage of the overall project? Is it a salary that they get paid for managing it? Maybe just give a little bit of insight into that as well.
Sure. So each syndication structure is different, but I'll give you kind of an overall guidance. So majority of syndications have a so-called acquisition fee, which is basically charged by the general partners for the homework they do ahead of time for finding the asset, doing due diligence, inspections, negotiations, and deciding to buy it. That acquisition fee ranges anywhere between 1% to 3%. Then once the asset is purchased, there is so-called asset management fee, which is charged for managing the assets. Again, that's for doing the overall asset management strategies, for overlooking the renovations or construction within the strategy, and for making sure that the investors are happy, managing the investor relations overall. And that fee, I would say, again, don't quote me on this, but it ranges anywhere between 1% to 3%. And these numbers could be different. Some may be lower, some may be slightly higher. I'm just giving you a more or less of a ballpark of what's going on in the industry. And the third common fee is the disposition fee, which is charged when the asset is disposed of. And that fee, again, could be a couple of percentage points, but it differs from one investment to another. In addition to that, where each investment as a split of investments between investors and general partners. And the splits can go anywhere between 10 to 90%, to 20 to 80, to 40 to 60. Each partnership has its own structure. They may also have more advanced splits where, depending upon reaching certain IRR, the splits could differ. So, for example, the split could start at, let's say, 20-80%, where general partners get 20% and limited partners get 80%. And then once, let's say, 15% IRR is reached by the investment, the split turns into 50-50 split between passive and active partners. But it differs not only by syndicator, but it differs from one investment to another. That's why I always encourage investors to read the offering memorandum and then to read the private placement memorandum, because all of the details are always disclosed in all of the documentation. So if you think there are questions that you have that are not answered, they will always be answered in the private placement memorandum because they're very detailed.
Sure. All right. One question more before you, Alina. We'll wrap it up here in a minute unless anyone else had any other questions to get typed in. Obviously, you've been on the side of being a limited partner. That's how you kind of got started, and probably maybe what a lot of people here on the webinar might be looking for. So you've been on that side. You've also obviously been on the general partner side. What do you think is your top tip to a limited partner? Maybe something you've seen people who are limited partners come in, either they have wrong expectations or they're expecting something different. What's kind of a tip you would leave someone, your primary piece of advice for somebody looking to get involved as a limited partner in a syndication, what they really need to know, or again, something maybe you see that people miss quite often?
Absolutely. I would answer that question by describing an ideal limited partner. It would be someone who is busy with their business, busy with their family or job, and either doesn't have the bandwidth to become active investor or doesn't want to actively manage the property at the current time. The syndication would be an ideal investment for them because they can ease their way into the investment and then later on decide whether this is something they want to take on actively. By observing what general partners do, by being a part of syndication as a limited partner, they get the return, so they get paid by observing the partners, and by the same token, it allows them to determine whether this is something they want to take on to the next level and become general partners themselves down the road. And as I mentioned earlier, this is the road that I've taken, so it's definitely possible for anyone in a similar position. And I encourage you folks to check out syndications in general and determine whether this is a strategy for you.
Great. Well, Alina, thank you very much for great information today. Again, her information is here on this slide. For anyone who's listening live, jot it down. You can give Alina a call, shoot her an email with your questions. Again, if you're someone listening to the recorded version, please reach out to Alina. And my contact information was a little bit earlier in the presentation if you have questions specifically on self-directed IRA accounts. But at this time, if we don't have any other questions, again, I want to thank you again, Alina, for participating.
Thank you, Scott, for having me join you. It was a great presentation. Thanks a lot.
All right, again, thanks everybody for logging in, calling in. We'll look forward to seeing you on our next webinar. Have a good day.